So I'm going to build an idea on how the market may, in fact, set this up. And if I understand that this is where it's likely to go, and what I mean by that is where's the draw on liquidity? Where's the market likely to go? What are we looking for in terms of potential expectations and where the market could trade to? And that could be something like this. We go to, we have relative equal highs right here. Okay. Very simple, smooth price level. The market's gone down a lot, several thousand handles. Okay. We had a huge gap, new week opening gap here. So where we settled on Friday and where we opened on Sunday at 6 o'clock last night, Eastern time in the States, that new week opening gap, that's a draw on liquidity. But we don't need it to trade all the way up to there. So where is the low hanging fruit objectives for just short-term bias? This is what I'm teaching you, Caleb, initially. I want you to think about where the market could draw to right now, where it could go to next. And what that does is it gives you something to focus on. And it also gives you a way of measuring every individual candle's formation and what your expectation is as it's forming and what the next candles should do and how they behave and what it feels like for you when you do this. Because whether you want to admit it or not, when you're first starting, the majority of your time is going to be spent in uncertainty, in times of confusion. It's going to be fearful. It's going to be, well, it's going to feel very anxious. You'll feel anxious. You may even start feeling body symptoms of tinglingness, lightheadedness, feel like you're going to get sick. And you may still only be in a demo because what you're doing is you're elevating the outcome to a level that is not expected. We have this short-term high here, post 8:30, meaning after we had 8:30, right here we have 8:36. So the market went below these relative equal lows. So any liquidity below that, they disrupted that and then took it above this short-term high. Took it above this short-term high and traded right inside this fair value gap right there. So when you're watching price, Caleb, you're looking for how the market maneuvers and trades and books between obvious price levels with old highs, old lows, and inefficiencies. They're the only two things you're worried about. You're not trying to predict a direction on the day. You're not trying to be right about 50 handle runs. You're just studying, observing. Okay? This down close candle here, after taking out the liquidity, and then we have displacement here. Displacement is where the market runs against a pre-session, pre-day, pre-trend or price swing direction. In other words, it's a counter move to what's already been in play. So the market has dropped here, and then we moved aggressively above this short-term high. This high being traded above there, we go back down to this down close candle. That down close candle is a order block. We have displacement, it took liquidity, and the market has been one directional. Now, what makes that an order block specifically is that it has happened post 8:30. Now, it could have formed right at 8:30 because 8:30, the algorithm will start spooling for liquidity or inefficiencies, one or the other. Now, in the beginning, you're going to want to know, because you're probably asking right now, can you just tell us what is it going to reach for? Is it going to go for an old high or old low, or is it going to go for a fair value gap above or below? Both. It's going to go for both. Okay, so when we look at individual setups like this, you want to sit down in front of the marketplace right before 8:30. Okay, preferably 8 o'clock, and you want to look at where the highs and the lows are in deference to the 1 minute chart and the 15-minute time frame. So I'm going to change this chart over here to 15. So here's what 15 minute looks like here. And if you look at where we came from, see this high at 7 o'clock in the morning? That's this high right there. See it on the right chart? So this chart, this larger chart here is the 1 minute, and this is the 15-minute time frame. 15, 5, 1 minute. Those are your first 3 time frames to worry about. Okay, and I shouldn't say worry because it's kind of like gives you a subconscious concern that you need to worry about it. You don't need to worry about it. But the levels and inefficiencies on the 15-minute time frame, the 5-minute time frame, and the 1 minute time frame. If you're brand new, you don't know how to trade ICT, you don't know how to trade price action, you don't know how to trade period, okay? You don't need any other time frame. Okay, you don't need anything else. You don't need a daily chart. You don't need an hourly chart. You don't need a 31-minute chart. You don't need a 17-minute chart. You don't need a 15-second chart. You don't need anything below a 1 minute chart. You don't need anything else to do what I'm going to teach you. Okay, this is what you're doing. You're studying price at specific times of the day. If you're not writing this part down, you're blowing it already. So between 8 o'clock and 8:30 in the morning, New York local time or Eastern Standard Time, in the US. Everything I mentioned in terms of time, if it's the time that matches New York local time. So set a clock. If you have your smartphone, there's a way that you can pull up world time and put one in there for New York. And you'll always know what time ICT is saying to look for these things to happen because they're never going to not be there. Write that down again, okay? And underline it. This is always absolutely without fail. It's never not going to do it. It's always every single effing day. It's going to do this very thing. It's going to do it. It's going to absolutely do it because there is an algorithm and it does this to spur on emotional interest or tangible orders that are actually sitting out there. Real orders that are sitting above and below or inside of inefficiencies where the market needs to offer fair value to the marketplace. So what is it reaching for? It's reaching for old highs, old lows, and inefficiencies. That's the fair value gap. SIBI, BISI, that thing. So once we know that the market is likely to do these things, that's a characteristic. It's an algorithmic characteristic. You don't need anything else besides this element as the foundation to what you're trying to trade, and you can make all the money you'd ever want. I'm going to say that again in case you missed it. You're trying to find right now, you want the daily bias and you want to be able to buy below the open and hold for the whole entire day. But are you really doing those things when you try to trade? No. Because as soon as you get 10 handles or 10 pips or whatever, you start struggling with holding on to the trade. You're paranoid that that winning trade that you just found out just fell into your lap. Oh my goodness, I'm winning. This is something new. I need to secure this. But then you're thinking, oh wait a minute, I'm supposed to be holding for the daily range. And now you're wrestling. And that becomes a real hard wrestling match, doesn't it? It makes you feel nauseous. And if anybody tries to talk to you, even if they love you, your spouse, your girlfriend, your boyfriend, your child, your dog comes over and nuzzles up next to you, any other time you're like, oh, this time, get away from me! Can't you see I'm trying to worry about this 10 pip handles move? The weight of the world is on my shoulders right now, and you're coming at me with this? You know what it means. You're stressing out. Why? Why would you have that response? Folks listening to headphones are like, oh man, this guy. You're awake now, aren't you? But that's the reality. That's what it's like. And you'll feel it if you've never been there. You'll feel it. But the reason why you feel that is because you don't know what you're doing. You haven't done this part long enough where you're completely desensitized to, okay, I'm doing this exercise to get comfortable with anticipating price moves. I'm getting comfortable with not knowing what it's going to do next candle, this candle, 5 candles from now. But I think it's going to draw to specific price levels. So if it clears that short-term low we talked about, what's it going to reach into? We have this inefficiency here. How long does it take to do that? And then you record, you screenshot this, and you say, okay, well, it took 1, 2, 3, 4, 5, 6 candles from this volume imbalance to run above this short-term high and get into this SIBI, which is a sell side imbalance, buy side inefficiency. A fair value gap that has a down close is a SIBI. Okay, a fair value gap that has a up close is a BISI, buy side imbalance, sell side inefficiency. So what you're doing is you're measuring because you have zero baseline experience. You have no continuity in what it is you're reaching for or looking for in price action. And you study how long it took and you record this many minutes. And you also are honestly going to record in your journal within the screenshot, like maybe over here or somewhere over here. You're going to record what it felt for you physically. Were you anxious? Did you second guess that it was going to run there? Did you feel excited the entire time? Were you impatient that you thought it should have moved there sooner and faster? Did certain candle formations cause you to, doubt it? Did you have a point at which you thought that it was given another opportunity to trade to, or not trade to, but offer another entry, like say for instance, like if you wanted a pyramid. Pyramiding should not be part of your repertoire yet. That's something that you need to be doing maybe a year after trading with one contract. This is the draw on liquidity. Draw on liquidity is just a initial reasonable assumption on our part to determine a directional move that could unfold. It does not mean and it does not define the absolute terminus to a price run or the be all end all target. In plainer terms, the market's probably going to keep moving until it gets to this level. It doesn't mean that it can't have retracements lower. It doesn't mean that it can't make a lower low than it's done here. Highly unlikely, but it's still an initial idea. So when you're first trying to learn how to read these markets, when you're first trying to determine where the market's likely to go, you have to strip away everything that you're trying to force into reading every single individual candlestick. And if you watch a lot of my videos, or if you have a lot of notes, or you've dabbled in things, chances are you probably already have a pet technique that you want to be yours. And you may not even be good at using it yet, but you just want it because it has a cool name, like a Reaper fair value gap. When I taught that to my private mentorship, they're like, "Oh man, that's going to be my thing. that's gonna be it for me." Or Event Horizon, which is the midpoint between two new week opening gaps or new day opening gaps, and because of the names, okay, these names are meaningful to me. They're not meant to inspire you to want to do them over another. It's just that's what I name them. I got 81 of these things, so it's a way for me to keep track of what its purpose was, and or it kind of puts a little stamp of when I discovered it and something had a impact on me and it was a cool name or inspiration to it. So when we're looking at price, as a brand new student not knowing what to do, you want to make this kind of like a game and a discovery, something fun, not a video game, okay, but it's a game of determining, does it have what it takes to move to these highs here? A way of saying it to yourself that's very disarming. It's okay, I see how this is smooth. These two highs are relatively equal. That looks like a real nice, obvious flat space in price. We don't see that same flatness down here. You see that? So in other words, if you had a shark, if you had two sharks rather, you have two sharks in front of you. One has had its teeth removed. Well, that would be represented something like this. This is the shark with no teeth. It's basically got gums. Okay, there's no teeth there. Down here, there has been a shark attack. How do we know that? Because we can see the wounds from the teeth, the jaggedness, the jaggedness, the jaggedness, and now it's going to another frenzy or feeding. Where is that? Well, we've just created one. We have this high here that's really close to this one. You see that? So you observe price action and you're looking for areas that look real smooth and safe, where they say peace and safety, sudden destruction comes upon them. Any time that you're looking at price action, and it doesn't matter what time frame you're looking at, okay? If you're looking at it through the lens of a second chart, sub 1 minute, or a weekly chart or a monthly chart or a quarterly chart where it's 3 months of data compressed in to make the candlesticks, it does not matter. This principle is always true. The market will go to an area of smoothness for the purpose of disrupting any orders that would be resting above or below it. We've already mentioned down here, let me show you. Now, don't be discouraged if you can't watch this stuff real time and see it or outline it in advance. It's okay for you to come home for work and look at your charts after the fact and go back and look at this and study it as if you have obviously the benefit of hindsight initially, but you don't want to stay in that very long. So you're going to have to procure yourself some instruments that will allow you to watch price action, not with market replay. So what we're looking for always, the first thing that you're looking for, Caleb, is where is the market smooth on the 15, the 5, and the 1 minute chart. Is that complicated? Nope, it's not complicated at all. It's real simple. What does it look like to be smooth? Well, when you have price levels that create highs, like this swing high here and this swing high here, they're real close to one another. See that? When you're looking for relative equal highs, here's your secret weapon for it, okay? How do you know it's a high probability relative equal high that's likely to get swept or traded through? How do you know that, ICT? What differentiates that from any other? Okay, it's this. If you have two swing highs, if the one to the left is slightly higher than the right, you have a very, very high probability that they're going to want to take it above there. Just like you see here. We have a high, and then the swing here happens to be just a little bit lower than that one. Here's what's going on. This is called priming, okay? Priming is where you continuously create, inspire, or manipulate the expectations of a large number of investors. And they think, oh, it's going to go through that high. But then there's a lot of folks that don't want to see it go there because they went short. So when the market goes up here and stops and turns down, what that does is it creates a sympathetic sigh. The shorts are relaxing. If the shorts are relaxing, what are they saying? They're saying that this is now what? Resistance. So anyone that takes a new short position, where are they going to think that the safest place to put their stop loss is going to be? Right above these highs. Why can we trust that they're likely to take that relative equal high out? Not that it will that session that you're trading, but it's high probability that this will be swept when the second or the one to the right, that swing high is lower than the one to the left that frames these two as relatively equal. Okay, same thing is occurring here. We have this high here, this high here, this one being slightly lower than that one. So when the market went up like this and we had this drop down, what that causes is a sympathetic sigh. What is that causing people? Anyone that went short here, they feel like, okay, that's scary because it almost went to that high where their stop loss would be if they're trying to go short in this area. See that? So what do you think it looks like when we have relative equal lows? What would be a high probability relative equal low that the market is likely to draw down and go below? It would be a low that has a slightly higher low. In common terms, it's referred as a failure swing. Okay, so a failure swing. Now a lot of people say, "Oh, see, he's just reinventing." No, See, what you're trying to trade that. That's what a failure swing is. When you're trying to trade long or short on that second pass that doesn't take out the low or take out a previous high. That's selling short a failure swing. Okay. What I'm teaching you is how to identify in price action where the algorithm will refer back to and why. What are the central tenets as to what the algorithm is referring to at a specific time of day, most important. And then it refers back to these because, okay, it sees this high based on time, and then the high prior to that one is here. So it's very simple for the algorithm to call that information as an array and say, okay, this high was at this time, and this high was higher than prior to it. And they're in close proximity. What's the filter? I'm not going to tell you that, but it's not very much in terms of difference between the price. And when you have that element, the market will invariably start marching back to those levels. It does not matter. Listen, folks. It does not matter how many buyers are buying the market to go up there, and how many short sellers. Okay. The proof of it is just look at a depth of market. Look at a ladder. Okay, a dom, not a dome. Okay, I'm so tired of hearing people go. It's not a dome. Do you see an E at the end of that? It's DOM. It's a dom. Okay, depth of market. Look at those orders. There's no imbalances there. There's no imbalances. There's just as many short orders below the market as there is above. But yet the market will still march and march and march and march and go to the beat of the drum that I tell you it does. It reaches to these levels because it's coded to do this. Between 8 o'clock and 8:30 in the morning, you want to sit down and determine where are the smooth locations in price action on the 15-minute, the 5-minute, and the 1-minute. Okay, let me go. We've had the 15-minute on. Let's go down to a 5. Okay. So right away you can see that this high here is relative to that one, and this one here also with that. This one being slightly higher than that one. So there's a lot of liquidity that's sitting at 17,820.75. Now, real important, it does not mean that it has to happen during that session. It does not mean that. And that is the underlying risk that you assume every single time you take a trade. You're looking for things that are going to stack the odds of probability in your favor. It does not mean it's an absolute guaranteed outcome. See, I have students that literally take the time and waste their time in writing me an email. Sometimes they're like novels or novellas. And usually it's like 3 paragraphs of congratulating me and worship and whatever. And I don't like that. And usually when I get that kind of stuff, I immediately just push the email away. I don't want you looking up to me. I don't want you worshiping me. I'm not the greatest of all time. I'm not the GOAT. I'm not none of those things. I'm just a guy that has a whole bunch of information and experience, and I want to share it with you. And I want to see what you do with it. But these individuals will say, I need you to tell me how to make sure that I don't have this wrong. I only want to take this pattern. So how do I avoid taking losing trades with a inversion fair value gap or a mitigation block or the breaker? How do I know if it's a breaker or if it's a shift in market structure? Well, that's easy. You have to have a higher time frame premise and a directional draw where the market's going to go. And if you think it's going to go higher, when you see the market creating a short-term turn, well, I'll give you an example right here. We have the relative equal lows here, and the market drops. You see that? So this drop down here, every up close candle on this time frame, all of this right here, that is your breaker. The most sensitive candle or range is going to be the last up close candle. Look at it like this. That's this range low. And see where the body stopped right there? We wick through it, I'm not denying that, but the damage is always done by the wick. And the range high there. oops, sorry. That is your bullish breaker. But the range here from that up close candle that starts all these consecutive up close candles, all of that is technically the bullish breaker. But the most sensitivity is going to be seen in that last up close candle. That is not supply and demand. That's not supply and demand zone. Sam Seiden would never, ever, ever refer to what I just said. Never, he would never do that. And he would never consider that anyway because we're cutting through candles. Because we're looking at what an algorithm is doing, not some floor trader ticket runner's perception of something that doesn't really exist. So the turn here at the bodies, that tells you what? It tells you the narrative. So what is it going to do? It's going to go higher. Okay, so what at that time would you focus on? Well, you have this short-term high here. The inefficiency that's traded to there. We want to see it trade above it and then act as what? Support, which would be a what? Inversion fair value gap. To do that, what would it reach for next? This high and this inefficiency. Does it do that? Yes. What are the bodies doing? Stopping just at that same level here. And more specifically, and my eyes didn't notice this when I put it up here. Do you see that little separation? That's a volume imbalance. Go back and listen to the other lectures. You have to include that volume imbalance when you have a fair value gap, whether it be BISC or CIVI. There you go. And you can see the bodies being encapsulated by that. And now the market trades back up into that. The bodies candlesticks are trading inside the inefficiency. It wicks above it, but look where the bodies are stopping. And look where the bodies are over here. Where's liquidity at? Below here. Nothing in here. This is all very balanced price delivery because it's back and forth. Every other candle is overlapping the highest high and the lowest low, pretty much kind of like coloring it very, very, very good. Back and forth. All this price action is back and forth versus then we have all these run where we have separations in here, back down into that breaker there. This response right here to what it's just done there, that expectation and response in how price can react to levels like that, that's a nice little scalp right there. I mean, look at it. Move from 515 to what? 596. That's a good run. You can't get 20 handles out of that on a 15-second chart. You can if you know what you're looking for. Now also notice that we've created again high, lower high, high, lower high, but real close to one another. When did it form? Prior to 9:30. So we have 8 to 8:30, and then you study 9 to 9:30, because it's going to do what? It's going to look and seek the liquidity or inefficiencies. So here's 9:30, right there, forming on the bullish breaker. It trades down, and then we have relative equal highs here. I don't like to usually do this, but I have to do it for the sake of discussion. So we have these relative equal highs, this high and that high, relative equal high, and we have this area up here. So if the market's going to do what? If it's going to make a punishing move towards the shorts that want to see it drop, because the market has dropped early on, 7 o'clock in the morning, okay? And we have all these very clean levels. What did we just do here? We have a low. It was traded down into. It disrupted this little area in here. So it's made this area jagged. Remember I was saying earlier where the market's real smooth over here versus what it was doing down here. Where has the work been done? Meaning, if there is a group of traders that are very cannibalistic and they tend to be more correct than wrong, or if they are the ones that generally make the money more consistently than the ones that don't. In other words, think of like the World Series of Poker. Okay, if you ever watch that, it's really fascinating to see how the long-term players that always find themselves at the final table. They may not win, but they always find their way at the final table. That's experience and that's skill. Well, you can see those things in price action. They're like fingerprints, okay? You can see when the cannibals come in and they devour the pygmies. They go in there and just chew them all up. And it's where the market is made jagged price delivery. Always. It's always like this, folks. It's never not going to be hidden from you, okay? It's always plain sight. But see, you're so enamored by animal patterns, harmonic patterns, gimmicky named supposed retail indicators. Everybody's got a new indicator. I got one for you that's going to beat all of them. It's the open, high, low, and close, and the clock. So we had these relative equal highs swept here. See that? Case study, bullish breaker to there. So how many candles did it take to do that? You screenshot it. How many handles did it run from the low to that relative equal high being taken out? And once it does that, keep the chart active with it on there, but then just make it very, very light. Well, not that light degree. Make it light. So that way you can still see it, but it doesn't have all of your focus. So that way it allows you to focus on, like, there's a fair value gap here. We traded down into mid gap, which is this wick here. Since price is above it, that makes it a discount array. Consequent encroachment of that trades to it. We want to see it run above this high here. Some of you that are trying to learn how to do this are having a blast with this, because not only am I giving you things to talk about in your own journal of focus, but you're also seeing things unfold over a live chart, and you're watching on your live chart. Okay, so this is not market replay. It's not delayed data. Okay, it's not after the fact talking narrative over a chart. Everything that these asshats leave comments on in my YouTube comment section that you can't see, but I see and getting amused by it. So here's the relative equal highs there too. So now, same thing here. You want to mute that in terms of its importance. And now you want to see, does it have the wherewithal to run aggressively for that 17,820.75? But the point is this. The very, very first thing you're doing as an undeveloped, unrefined trader, someone like my son Caleb, okay? Don't be offended by that, son. It is what it is. I've called you worse things. The idea is that you're looking for the smooth areas where the price is so obviously being defended and being presented and being offered for retail-minded trades. See, I don't look at charts. I absolutely don't look at charts and think of what retail pattern here I can use to get in sync with a price run. Look at that beautiful delivery right to that volume imbalance there, which is inside encapsulated in that SIBI. Went right to the high of that. Now, when you're looking at price, you're looking for the obvious, very, very, very smooth relative equal highs or relative equal lows. How do you know which one they're going to go to? How do they know? Well, I'm sorry. How do you know? How can you trust? How do you determine which side of the marketplace it's going to reach for? Because what this is going to do, it gives you the initial building blocks to understanding bias. This would be further amplified if I was showing it to you on a 15-second chart. If you have the capabilities, I'm not saying you have to, but if you have the ability to look at a 15-second chart, study every level I've outlined here and the logic of why it was going to draw up into that 17,820.75 level. I gave you the bias before we really essentially started today. I explained to you in very, very bland commentary, almost boring really. It didn't seem scientific. I used analogies that I thought were very simplistic. You know, when we're looking at areas that are very smooth, contrast this area up here, how that was very, very smooth. And these, remember these levels over here? I told you this one. In addition, if you weren't looking at that, that's the benefit of looking at 3 time frames. Because if you can frame an idea of why the market's likely to draw to a high or a low or inefficiency that is completely visible on 3 time frames, that means you have 3 time frames telling you, hey, pay attention to me. And if that time frame or those time frames are in agreement with a relative equal high or a inefficiency above the marketplace, that means like something like this right here, or this right here, or this right here. They're all stepping stones. Notice that? They're all stepping stones. Inside the context in your overall narrative that the market was going to go here. When I first started the live session, what's the first line I dropped on the chart? This one. It was based on these two highs here. That's all it was. Why did I pick this high? Yes, he got my question. Finally, I've been sitting here the whole time you're talking. Why'd you pick that high? What's the first thing I told you? The algorithm is going to go based on time. But 7 o'clock is a very key time. That starts what? The morning session. It matters not that we're trading Forex or futures. The morning session, AM session, starts at 7 o'clock in the morning, New York local time. Okay, so you can have a model that says, I can't be in front of the charts between 8 o'clock and 8:30, and maybe you can't even trade the 9:30 opening bell for indices because you have to get ready for work. Okay, but it just so happens that the time elements in your personal life and geographically location in the world, that it allows you and affords you to look at the market between 7 o'clock and say 7:45. Worst case scenario, 7:30. If you're going to work with smaller time frames, you absolutely can use 7 o'clock to 7:30 as a model to do this very exercise. Same thing. So your key times are this: 7 o'clock in the morning to 7:30. In that 30-minute window, you're going to look for relative equal highs and relative equal lows that have happened prior to 7 o'clock. Okay? And you're going to be looking through the time frames of the 1-minute chart, the 5-minute chart, and the 15-minute time. Now, Caleb, you're not expected to do anything else beyond that until I change the depth of what your focus should be. Right now, you're just having 3 charts up. Since the 15-minute time frame is pretty static, you only need to refer to it once in the morning. And then your second chart could be the 5-minute chart. And we'll go back. That's what it is right now, 5-minute chart. But then what you're doing is you're watching between 7 o'clock and 7:30, or 8 o'clock to 8:30, or 9 to 9:30 opening bell. You're looking for, where is the market smooth? Smooth. But when you set up a framework of whatever you're going to study in the morning, if you're going to trade the morning session, your key times, you have to absolutely be in front of the charts between 7 o'clock and 7:30 in the morning, always New York local time. Okay? If you can be in front of the charts by 7 o'clock, this is what you're doing. But if you can't, you do the same thing at 8 o'clock to 8:30. The same thing at 9 to 9:30. Okay? This is your pre-market range. Write that down, because if you don't write it down, you're going to forget. You're going to call it the opening range. It's not the opening range. The opening range is the first 30 minutes after the opening bell. At the New York session, the first 30 minutes after 7 o'clock to 7:30, that is your pre-market range. 7:30 to 8 o'clock is your opening range. Oh, remember I was telling you I could trade every single hourly candle? Now you're starting to think. The gears are turning, aren't they? Oh, it's fun, isn't it? And obviously the 9 to 9:30, that's your pre-market range. And then post 9:30 to 10 o'clock, that's your opening range. There is no 15-minute opening range. I don't care what anybody tells you. Okay? It's a 30-minute opening range. That's algorithmic. Okay? So what you're doing, and this little range here that's being shown here with this rectangle, what I'm saying is this is essentially that 30-minute interval, whether it be 7 o'clock to 7:30, or 8 o'clock to 8:30, or 9 to 9:30, that pre-market range. In that range, what you're doing is you're looking at this line, or beginning of that shaded area, would delineate the 7 o'clock, or the 8 o'clock, or the 9 o'clock, where it begins at that specific top of the hour. And then this would be the range that makes up that first 30 minutes. Now, it's not obviously to scale, but I'm oversimplifying it for the purpose of teaching what I'm saying. Prior to that range, anything before or to the left of this, you're looking for equal highs or equal lows. Which side has it? because that's your bias. It's going to draw to that. How do you know? If you have both, because I heard you, you're thinking it. But what happens if you have a relative equal high here and a relative equal low here? Which one are you going to go for? You wait for the first one to get disrupted, because once that happens, then you work to the other one. That's your bias. So you have to defer and wait. Now, gamblers or live streamers that just want to have people watching and doing anything and not really executing on stream, but after the trade starts moving in their favor, then they'll show, oh, I took a trade here. What good is that? What good is that? That just proves you're not confident in what you're doing, and you're going to show it after it's moved in your favor. Talk about it, explain it, and then do it. I'm going to do that. But today I gave you a clinic on how to determine bias, how it's easy for me and it's easy for you. Whichever one has the relative equal highs or relative equal lows, that's a smooth area. It will be disrupted. Anywhere where you see jagged edges like this down here, see how it went jagged and then ripped higher. What's it telling you? What's it telling you? I'm going to look for buy side liquidity, buy stops. This has been a trap. They engage traders to go short. They're trapped short on a breakout, or they're not trying to take the shorts out of the market yet, and that's why you see all this in here, a little bit creeping up. This is all balanced. That's why this spike stopped right at the top of the breaker here. Isn't that interesting? Isn't that interesting? But anyway, the market trades down to the bullish breaker that I absolutely identified before it hits it, and then goes to the relative equal highs I told you to focus on, and then I gave you this one here, and I told you this imbalance is prior to these relative equal highs being taken, but this was where we were focused on, and look where we're trading at. See that? Now, in closing, because I really do have to close now, in this price run, and we're not going to use all of this. This is capitulation now. It's getting real excited. If we have this segment of price action, okay, if I'm identifying this area up here, okay, more specifically, let's be honest, because this is the one I drew your attention to first, so we'll stick with that one, even though that other one was later mentioned, even before it got traded to. That high rate there. Did you get the video a thumbs up? By the way, did you take a second of your time to press that up thumb icon on YouTube? That's free. I didn't charge you anything for it, because that really is a way for you to communicate to me that you had fun today, that you really did leave and learn something, and now you have something that's tangible that you can go back and look at every single day in the past and journal it, because you should be doing that. Every single day, you break down the chart starting at 7 o'clock in the morning, have 7 o'clock in the morning all the way till, say, 11 o'clock. Okay, so it's 4 hours. And you want to have your 15-minute time frame, your 5-minute time frame, and your 1-minute time frame charts, and annotate. And it may require you to have multiple charts from that individual 1-minute chart where you're zoomed in and you're annotating something specific that are very salient to you. Because most of you may not have trusted this as a bullish breaker. When you saw this drop in here, you're hoping, and some of you were probably tickled, your asshole was puckering, thinking, he's getting screwed in front of all this. I love it. I love it. I love it. Oh! You're drooling. And then what happens? It rips your face off. And then I'm right again. I know. I know. I could have a lot of fun with that, but I'm not, because I'm here to try to teach my son, and you're here to learn. If you go back through all of this price run here, okay, what you're going to do is you're going to focus on the points that make the most obvious sense to you, that you could see, and it says, you know what, I understand this. Even though ICT pointed out this breaker, you may have noticed it, maybe you didn't. If you didn't, that's not your PD array. If you noticed that it traded down into this fair value gap right there, inside of this old SIBI, which is essentially where? About midpoint between where we expect price to trade to, which is above these highs, and where it traded from. See that? So if we see where it's likely to go and where it went from, where it originated from, where's the midpoint? Well, let's do a simple measurement. Here's your fib. And we're going to say something above these relative equal highs. We'll just randomly pick an area right there. Okay, I'm just being very bland. There's no real reason I'm picking that price. It's just simply slightly above the relative equal highs. There's no other logic, simply that. Okay, So I'm not trying to complicate anything. But if you take that and you go down to the lows that are relatively equal, not the lowest low, that's the manipulation. You want to use the relative equal lows like that. Okay, you see that? And then you have essentially the midpoint here. In close proximity to that, you have this fair value gap and you have this fair value gap. And this one here can be used, even though it's a little bit above equilibrium, because we didn't take this high and that high out, which I was outlining to you real time. We didn't take that out yet. We didn't take out these two relative equal highs when it was trading down to the breaker. But what happens when it trades up here, and then at real time I said, watch this fair value gap, watch the stream. Go back and watch the stream. When we were trading right there, I said, watch, and here we are, we're trading this fair value gap here, and then takes off and runs to where we were waiting to see it deliver. The smooth areas are going to be attacked. The sharks are going to go to the still water. That's where they're going to go. Why? Because as soon as someone in there starts shaking in fear that their stop's going to be taken, that still water will ripple, and that triggers a frenzy, and the sharks are going to go right there. You don't trade into levels where the sharks have already had a frenzy, and that's down here. Okay, they've already done the work. There's been an attack down here. How do you know? There's been the great disturbance in what price was doing and how it's delivered. It's jagged like shark teeth cutting through the side of a whale's body. It's been damaged delivered. You can see it. It's physically represented in the jaggedness of the swings going down, where we don't see that jaggedness up here. It's nice and smooth, real inviting. It's safe. Put your stop loss above me, like a siren calling out to the sailors. Come to me, and he crashes them on the rocks. I know, Mr. Analogy. I don't know where it comes from. It's a gift. But you have to go through all of this price action in here and determine what price level makes sense to you. Which one resonates with you? Do you see the fair value gaps where I was outlining before I did it? Did it make sense when I was drawing them out? Did you change your expectation and get fearful that I'm wrong and it's not going to go up there because it had this drop here? What's occurring here? The only thing it's doing is at 9:30 during the opening range, it's doing what? It's creating a Judas swing. Something that's opposite to the real move. The real move was given to you with these highs. It's going to go there. At any time, did you hear me sound nervous in front of all of you? I don't know how many people were watching. I think it was like 6,000 earlier, the first time I checked the stream's continuity. But I haven't seen, I don't know what the highest high was in terms of how many people were watching. We can see how that SIBI becomes an inversion fair value gap here. And then it sends price higher, retraces down, and then you have your second leg redistribution, and then sends it to the smooth area that makes up this market maker buy model. I knew it, ICT. Yeah, that's how it is. So when you're looking for the bias, okay, the easiest, most scientifically proven, 9 out of 10 doctors approve, ICT has nailed it down to a science of wherever the smooth equal highs are or smooth relative equal lows are at the beginning of 7 o'clock to 7:30 or 8 o'clock to 8:30 or 9 to 9:30. You have 3 opportunities, 3 chances, okay? As each one of these time windows passes by, so at 7 o'clock, we formed the relative equal highs. And then at 8 to 8:30, we didn't go up there yet. So that means that, what, 9 to 9:30, chances are that's the run. See how that does that? It increases the likelihood of it going there. It doesn't diminish it because it's building up more trust in that area right there. So the framework begins at 7 o'clock in the morning. Start looking for relative equal highs to form. Not before. Key takeaway is not before 7 o'clock. At 7 o'clock, look for them to form. Big takeaway there. Okay, if you're looking for relative equal highs prior to 7 o'clock in the morning, you may get it, but many times you're expecting the London session to be completely overrid, and it's most times not the case. So it kind of like builds in this filter where you're not trying to demand that the run on London is removed or dismissed because of price overlapping it and going back over top of it. Because the general consensus is we could see the higher low of the day form in London. So if it's bearish or bullish relative to a higher time frame draw, which is not necessary, notice I haven't even used that here yet. Only thing I used was a 15-minute time frame, a 5-minute time frame, and a 1-minute time frame. And I was framing it on the basis of time because I understand my algorithm. I understand what it's going to do. I understand exactly what these markets are going to do. Every single day, it will not stop. It will not be hidden from you, but it can be disrupted by manual intervention. And that will always cause me to lose. It will always cause me to be incorrect because that's something that we and no one can predict. It's their casino. If they want to come in and disrupt everything, it is what it is.